Welcome to Berman's Call. We're here to take your questions on both stocks and ETFs today. Here's how to reach us toll-free, 1-855-326-6266. You can also email your questions to bermanscall@bnnbloomberg.ca. Larry, we have new tariff threats on the weekend from Donald Trump. Steel and aluminum in Canada affected. How are you seeing market reaction and in general, or is it sort of a little bit less than what it was in April? It's softening a bit?
Yeah, markets are becoming somewhat desensitized to the rapidly changing and evolving tariff outlook. President Taco, if we can call him that, doesn't like that name, and so spoke out, at the close of the market on Friday. So markets didn't have a real chance to respond, and so last night as futures open, they were softening, but this morning we're right back to up small on the day, for the U.S. market. So markets are becoming desensitized. In the educational part of today's show, I'm going to talk a little bit about what I think where the focus is going to go, and ultimately the hard economic data and how the economy is going to play out in the back half of the year. All these things factored in.
Let's talk about OPEC as well, OPEC Plus, because they agreed to the 411,000 barrels in July, which is what they've already agreed to twice so far this year. What do you think for pricing ahead for oil?
Well, I think from the U.S. standpoint, President Trump knows that to contain inflation, low oil prices. So I think we're in a regime where, from the U.S. perspective, between now and the midterm elections, low oil prices is a good thing because that's going to help keep inflation
the average
contained.
American, sure.
So if we look at oil prices there, it's come down. It was long thought the last 3 or 4 years that under 70, they would be buying back this strategic petroleum reserve. And now I think they will, but that might be below 50 at some point. So I think that's been deferred, that support for the market. And as long as supply exceeds demand, prices will stay, well contained, notwithstanding the little bump we got today.
Okay, so overall, what's your take on U.S. markets?
So I think we're going to be in a heightened period of uncertainty. Tariffs are part of that, but increasingly we're starting to see some economic data that is starting to soften. And in that environment, to me, these highs are good highs. We're not going to go through those highs unless we see a significant uptick in the economic outlook. And I just can't see that with all the uncertainties in front of us that have yet to be resolved. Having said that, the extreme low here is probably a good low until we see a real hard economic landing where we're talking about mass layoffs and recession. And that doesn't appear to be on this calendar year agenda anyways, but down the road, something to worry about. When
you compare now the U.S. to Canada, where are you landing? Also looking ahead to the Bank of Canada announcement midweek.
So, from the Canadian perspective, the outlook right now in market pricing, 20% chance they cut rates. If you look at the big six economics teams at the banks here, none of them are expecting a rate cut. So I doubt we're going to see one. Goldman Sachs is expecting one. But if you look at, the go forward, the Bank of Canada has been way ahead in terms of the U.S. market, in terms of cutting and being preemptive that way. Having said that, we get the employment numbers this Friday, and we're actually likely going to see a loss of jobs in Canada based on the survey. So, you do have that Canadian economy is structurally weaker than the U.S. right now, and we can think that the Bank of Canada will be biased towards cutting further as we progress.
Okay, let's leave the conversation there right now. We'll line up some phone calls for Larry Berman, so we'll get to those phone calls and emails when we come back. Here's the number to call us, 1-855-326-6266, or email us, bermanscall@bnnbloomberg.ca. We're back in a moment. Welcome back to Berman's Call here with Larry Berman. Now let's get to an email from Rick. He says, I'm currently holding about 90% of my portfolio in cash, and I'm considering investing that amount in the ZST ETF. In the meantime, would this be considered a safe strategy while I wait for a more comfortable re-entry into the equity market? If Donald Trump's in power for 4 years, he might be waiting a while.
So ZST is a corporate-based money market account. So it's going to generate about 30 basis points, ballpark, more than what you would get in a traditional money market fund. So Canadian T-bills right now from 1 month to 1 year are roughly in the 2.6% yield. You add a small fee for running a money market fund, and unit holders getting 2.5-ish, call it. So with something like this, you're going to get 2.8, 2.9. So that's just for perspective, and it's very, very safe. Very high quality corporate credits in Canada that you're investing in. Typically the term is under a year. So it acts like a money market account in that sense, and it's been a great vehicle for a number of years to get an enhanced yield on your cash savings.
Got it. Okay, let's go to the phone lines. Jim's on the line today from Montreal. Hi, Jim.
Hi, Larry. I have both ZWB and ZWK in my cash portfolios. With the tariffs on and off, up and down, and the stability of the financial markets right now, where would you add this coming year, or would you not add to either one of them, and why? Especially with the effects with the aluminum and tariffs going up, and then maybe affecting housing and construction. Thank you.
Yeah, so you're looking at covered call ETFs for banks, either U.S. or Canadian. And so, if the tariffs and everything else that's going on is going to be negative for the economy, then typically when the economy's weak, banks are going to underperform the broader markets. And so for me, both of these would be cautious on. I wouldn't say go out and sell them right now, but I would be cautious on them, and both of them at this point.
Okay, so be cautious on them. Mean if you have them hold them,
great yield. You don't need to worry about dividend cuts and things like that. But would I be taking money off the sidelines and putting it in? No, you're almost certain to get a better opportunity to do that at some point in the next couple of months. And so for something like this, a ZST would be a good place to park it until that opportunity where banks are a little bit cheaper than they are today.
Got it. Okay. Let's go back to the phone lines then. Renata's on the line from Oakville in Ontario. Hi, Renata.
Hi, good afternoon. Larry, I've asked about half a dozen people's opinion, and yours is what I wait for now to buy or to sell or to hold on to it. BCE, what do you think of it? And I appreciate your honest opinion. I hang up and wait for it. Thank you so much.
Okay, thanks, Renata. BCE, of course, parent company of this channel under the Bell Media brand.
It is indeed. And I've said many times in recent months, I haven't liked some of the decision making in terms of operating the company in recent years. Having said that, I'm a shareholder. We have some exposure. I have not added or taken away from it at the moment. Typically and historically, once you get a material rate cut on something like this, that's the last bit of selling where people who are, okay, get me out. So usually you're probably a lot closer to a bottom right now than you are a top. Having said that, you need a catalyst to
take it over the top.
To take it over the top and start the recovery. So I would say I would be nibbling or accumulating, but I don't see a catalyst to see this thing take off on the upside.
Were you surprised when they cut the dividend that you did not see more of a bump? It got a little bit of a bump, so it was over that $30 mark, which has been hovering around. Were you surprised you didn't see more of a bump from that because so many had been calling for that for so long?
Well, so you did see a bump. It went up like 15% over a couple of days, and then you're right back down to the $30 area here. And that tells you there's no catalyst to release it to the upsides. So you got that natural response over the few days. That was the last bit of selling, but it hasn't gone yet. So I think it's cautious. Caution is the word. I wouldn't look for another rate cut at this point, in terms of a dividend cut. I think would want to do, or what would have wanted to do, a kitchen sink type, having not cut the dividend for basically forever. So yeah, cautious, but I don't see a catalyst to lift it to the upside. There are probably other areas that you can invest in where there's some dividend and growth to the name. BC is not one of them at the moment.
Got it. Okay, let's go back to the phone line. Howard is on the line from White Rock, BC. Hi, Howard.
How you doing? Question for Larry. It's it revolves around leaps, and it would be the long calls, for example, on an ETF such as the XSP. So I'm just wondering what his feedback is. I think it gives you an additional leverage over the long term. So at this point, XSP, you can get March 2028 long calls, and if you get them in the money. I just wondered his feedback in terms of that type of a strategy. Thanks.
Okay, tell me a little bit about XSP.
Yeah, so S&P 500 exposure, and it sounds like he's talking about buying some deep in the money calls on it as a way to maybe use some leverage or get exposure to the market. So this is a very sophisticated strategy, and I wouldn't be out there recommending that most people look at doing something like this. If the S&P 500 valuation is pretty fully valued right now, then I don't love this strategy here. After a correction, sure. And if you're looking for exposure to the US market, what I do like a lot of at this point, with some capital preservation in mind, is the BMO series of buffer ETFs, where you get the market exposure, you get some upside potential. There's a covered call on it, so it's limited, but that call pays for some put protection. So I really like those right now because we are in a period of uncertainty. Is it going to go up or is it going to go down? And I'm more in the short-term camp, down before up. But long-term, you got to love the S&P 500. You just can't love it at 22 times forward earnings.
Got it.
Right? You just can't. It's expensive.
Let's go back to an email then. This is from Peter. Peter says, please comment on the recent rally in Bitcoin. Is it overbought? How to play such an event? Can you short Bitcoin ETFs? Any other strategies to recommend?
So
can you short it?
You can. Now, the borrow could be very expensive on something like that, so you got to be mindful of your cost of carry when you're shorting. But there are ETFs that are the inverse of Bitcoin. ProShares, for example, and Beta Pro have inverse ETFs where the ticker symbol is BITI.
Okay.
And so that gives you the one-time inverse. There are a few companies out there that have leveraged ways to play inversely.
Okay.
You got to be careful with those leveraged ones, but there are ETFs that you could buy that will go up if Bitcoin goes down.
Okay, so is there another strategy that you can share for Bitcoin, or is that pretty much where you can go with Bitcoin?
Well, at the moment, those are some of the
options.
more generic ones. You can get into Bitcoin, covered call Bitcoin. There's a bunch of them coming out as a ways to generate income and put some protection in your portfolio. But we'll leave that for another educational segment.
Got it. It's probably complicated. All right, let's go to an email from Sam. What is your outlook, he says, for Algoma amid these new tariff threats from the U.S.? Algoma did take a hit. Let me pull that back up right now. But what do you think with our steel players and aluminum players, given these on-again and off-again tariffs now up to 50%, according to Donald Trump, as of Wednesday?
Yeah, so I think you want to go back and look at the last time he did this with steel and aluminum and exposure to Canadian names. So you would go back, into the 2017 timeframe. Not sure we have that in terms of exposure here, but you'd have to go look at some of those and say, what happened then. And so I would say they're cheap for a reason. You probably need to have a high tolerance for risk and volatility to be able to put a position on right now. But these things are down compared to some of the U.S. names that are up
today, of course,
today in
yes.
particular, but in general. And so there's an opportunity there. Would I rush in today and do it? No, I think you kind of want to get a little bit closer to where there's some resolution here. And
Will there be resolution? And I ask because they do rely on our steel. They rely for about 25% of their steel from Canada. Are there workarounds for them that maybe Canadian steel gets omitted somehow?
Sure, there's that possibility. I mean, I'm not a policy analyst in the sense where I'd have a strong opinion on that, and I'd be confident making a recommendation on it. So I would say let's wait till we get a little. Let the dust settle a little. Let's get a little closer to where there's some resolution. See how the stock behaves. A stock that should be going up and isn't is something you don't want to own. A stock that should be going down and isn't is something you want to own. So I would wait till we get a little closer to seeing some of that behavior before you would maybe step into Algoma.
Got it. Okay, let's go back to the phone lines. George is on the line today from BC. Hi, George.
Hi there. A question for Larry. We have a U.S. dollar account with a bit of cash in it, a fair bit of cash in it, and we're wondering what should we do with that? Should we put it in money market? Should we change it to U.S. dollars, or Canadian dollars, or buy something with it? We don't want to invest in the States.
Got it. Okay, so good time to have money in an American account.
You don't want to invest in the States. Yeah. So there's ways to buy a U.S. security technically that gives you exposure to other parts of the world. So if you wanted to keep it in U.S. dollars as an idea. U.S. money market, again, you don't want to invest in U.S., but you're getting a 4.5% yield in a U.S. money market ETF or HISA. There are U.S. dollar instruments that trade in Canada.
Interesting.
So you're getting exposure to some of these things, getting a yield for it, as opposed to having it sit in cash. So I think the question I would ask back is how fundamentally are you opposed to getting a better return on your money versus your view on anti-U.S. because of some of the things that are happening politically? And I wouldn't know the answer to that unless the person would call back and give me that answer. But I would weigh some of those considerations. But there are some high interest savings accounts that give you that U.S. dollar return in U.S. dollars that trade on the TSX. And I would look into some of those.
Got it. Okay, I hope that helps George out. He called in from BC today. That is all the time we have for phone calls. But coming up next is Larry's educational segment. Back in a moment.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Back with Berman's Call and Larry Berman with us. It's time today for Larry to give us an educational segment. You're taking a look at the American economy. What are you paying attention to?
Yeah, so as we get desensitized from tariffs, and now those are still real, and it's going to matter how that plays out, we are starting to see decay in the U.S. labor situation that's been developing over recent months. And so I wanted to highlight a couple of graphics here. So this very colorful graphic right here is the JOLTS survey, and this is the job opening loss and turnover survey that we're going to get this week. And this white line here trending all the components together of where there's job openings. I know it's going to be hard to read for the viewers on the screen.
What's the timeline there? Sorry, I can't really make
So yeah, this is going back a couple of years.
Okay.
Okay. So you can see the number of job openings are continuing to fall. So the output in terms of the need for workers is falling. Last week, we saw yet another sort of uptick in the initial claims data. So the next graphic we have here is the blue lines, which is the non-seasonal adjustment of weekly claims. Then we have the weekly series, and then in there in orange is the 4-week average. you can see how cyclical this is. Generally speaking, in the post-COVID normalization, we've kind of hovered in a range. We're now back up to the top end of that range, where we're again worried that this is going to break to the upside. So we just heard from Disney laying off people. So that's a big part of, I think, what the market's going to start to care about, because it's going to mean the Fed will get off the sidelines and maybe start to cut rates. So that is pretty interesting. That's the initial claims. What worries me a little bit more is the continuing claims. So the next graphic we have here, and this is at a multi-year high, again, going back to the normalization of COVID, where it's taking people who have lost their job longer and longer to find a new job. So you have the three elements: less demand for labor from business, fewer job openings. You have an uptick in initial claims, although still very modest, an uptick. And then you have this continuing claims, meaning they're on the dole a lot longer than they have been in recent years. So you have all those things combining. And so this Friday, we get U.S. non-farm payrolls.
Okay.
And so there's some expectation that we get a soft number, not a negative, but job growth less than 100,000. And if we start to see the U.S. labor market weakening, it's going to matter a lot, because the market at 22 times forward earnings is priced for 8% earnings growth this year. If we start to lose jobs and recession risk becomes real, then the equity markets are not priced for that risk. Finally, we have the big, beautiful bill. Last graphic here. And this was put together by a gentleman that we follow on social media, as a guy at Piper Sandler. And at the end of the day, he took all the components of the big, beautiful bill and basically said, okay, we're going to get an economic bump into 2026, but the growth rate for GDP following that is going to be in decline. So this is not going to be the economic boost they hope. And while we might get a boost now, when we think about the go forward and what the markets are pricing in, not sure that the markets are correctly priced. Bottom line, if you want to participate in the U.S. market, use these buffer ETFs. ZJAN is my recommendation. Go have a look at it in the BMO universe on their website. See what it does for you. It gives you about 10% upside, and it'll protect about 15% of your downside risk as a buffer. So it keeps you invested in case it might go higher and I'm wrong.
Got it. All right, Larry, thanks very much. Appreciate that and appreciate you coming in. Join us for Berman's Call Mondays, 3 p.m. Eastern at 12 noon Pacific. Thanks for joining us on this show. The close is coming up next. Stay tuned for that.